Hey everyone, and welcome to This Explainer. Today, we're breaking down a very realistic blueprint for building a reliable, completely passive monthly income stream through dividend investing. If you've ever found yourself wondering how people actually make money while they're fast asleep, well, you are definitely in the right place. We're going to treat this whole process exactly like building a house. We'll start with the foundation, source the absolute best materials, and do a thorough inspection for any hazards along the way. Okay, let's look at our agenda for today. We're covering 5 main sections. 1. The passive income dream. 2. Doing the dividend math. 3. Building your portfolio. 4. The power of compounding. And finally, 5. Risks and reality checks. Let's get right into it. Section 1. The passive income dream. Now, it sounds a bit like magic, doesn't it? But really ask yourself, what does it structurally take to generate $1,000 every single month without relying on a traditional paycheck? Right off the bat, a core truth emerges here. This is a long-term architectural undertaking. It is absolutely, unequivocally not a get-rich-quick scheme. $400,000. Okay, before you hit the panic button seeing that you'd need $400,000 in capital at a conservative 3% yield to hit that $1,000 a month, just take a breath. Remember, we're building this blueprint step by step. You wouldn't expect to build a house in a single day, right? Well, you don't build a massive portfolio overnight either. So let's move into section 2, doing the dividend math. We've got to start with the basics. What actually is a dividend? Put simply, it's just a portion of a company's profit that they pay directly out to their shareholders. Think of the dividend yield as the bedrock foundation of your building. It literally represents how much rent a company is paying you just for owning a tiny piece of their property. So if you own a $100 stock with a 3% yield, they're paying you $3 a year simply for holding onto it. But you've really got to pay attention to the timeline here. You can't just swoop in, buy a stock the day before a payout, and expect to get paid. You have to keep a close eye on the ex-dividend date. That is the vital cutoff day to buy. Understanding this exact sequence is absolutely crucial so you actually collect the rent you're owed and never miss a payment. Now, let's see how the math plays out. If your target is $1,000 a month, so $12,000 a year, the amount of capital you actually need changes drastically depending on your yield. Notice how pushing for a juicier 6% yield literally cuts your required capital right in half, dropping it down to $200,000. But, and this is a big but, that introduces a serious tension between yield and risk. We'll be doing a closer inspection of that in just a bit. All right, moving on to section 3, building your portfolio. This is where we actually source our materials. The crucial point here? Diversification. You would never build a house entirely out of glass, right? You need sturdy dividend growth companies to act as your foundational bricks. Then, maybe add some high-yield stocks and REITs, which are real estate investment trusts, for the framing. And finally, ETFs, or exchange-traded funds, to provide a nice, broad, weatherproof roof. And, importantly, you want all of these spread out across completely different economic sectors. Because it becomes incredibly clear that you can never, ever put all your investments into one single company. If you're relying on just one main pillar to pay you, and they hit rough times and slash their dividend, your entire passive income roof just caved in. Diversification is quite literally your structural integrity. Section 4. The power of compounding. So when those dividends actually start rolling in, you're faced with 2 choices. Taking the cash right away gives you very slow linear growth. But utilizing a DRIP, a dividend reinvestment plan, acts exactly like a snowball rolling down a steep hill. By automatically using your dividends to buy more shares of the company, which in turn pay you even more dividends, you are massively accelerating your portfolio's growth compared to just pocketing the cash early on. It's a total game changer. Following this realistic roadmap, we can actually see how long it takes to hit that $1,000 monthly mark based on some very reasonable long-term assumptions. Whether you're adding $200, $500, or a full $1,000 a month, the trajectory is super clear. Consistently adding fresh capital while your existing dividends reinvest, that is the exact mechanism that turns a relatively small monthly contribution into a massive income-generating portfolio over time. Let's move to section 5, risks and reality checks. Look, no investment strategy is completely perfect, and we have to prepare for the inevitable storms. The most severe foundational cracks happen when investors panic sell during market downturns, or just totally ignore macroeconomic factors like inflation and interest rate changes. If you blindly overpay for stocks,
or neglect to check the underlying fundamentals of a business to see if its profits are actually growing, you are building your house on a very shaky foundation.
Which brings us to one of the most dangerous hazards on the entire job site, the yield trap. Chasing after very high yields is incredibly dangerous. An unusually high yield is often a siren song for struggling companies whose stock price has plummeted, and more often than not, they're just about to cut their payouts. So please don't be seduced by an 8 or 10% yield without rigorously checking the company's health first. Patience and quality are your absolute best defenses here.
So, how do we successfully execute this build? Well, it all comes down to a highly practical action plan to get wealthy slowly. Start as early as you possibly can to give compounding more time to work its magic. Maintain consistency through all those market ups and downs. Always reinvest those dividends via a drip. Focus entirely on quality businesses over those flashy yields. And finally, commit to an annual structural review of your portfolio's health to make sure your investments remain completely sound.
Of course, as we look over these blueprints, please remember that this explainer is not financial advice. It is always crucial for you to conduct your own research or consult a certified professional. Every investment carries inherent market risks, and past performance never guarantees future results. Building this stream isn't about finding that one perfect hidden stock. It's all about consistently investing in quality companies, staying rigorously diversified, reinvesting your dividends, and just letting time and compounding do the heavy lifting for you. So after seeing the math and the blueprints today, my final question for you is this. Are you ready to trade get rich quick for get wealthy slow and embrace the patient architecture of wealth? Think about it. Keep learning, stay focused, and I'll catch you in the next explainer.